All right, the objective of today's discussion is to dive into NVIDIA results for Q2 2025 and understand what all the noise is all about. NVIDIA is pretty much taking and swinging the market with it over the last couple of weeks, and I think there's a lot of nervousness in terms of what the capex spend is going to be, whether the growth rate is going to be 60% or 62% or 61.5%. And I'm here to look at the results, and then also value the company and see, is the juice worth the squeeze? Is it really something that we should be worried about in terms of a 200 basis point swing in results, or is there more to the company? So let's first analyze what the results are. The results are mind-blowing. There's nothing, as you can see on the screen here. The data center revenue for the business has increased from $18 billion in less than 2 years from time period. So in Q4 2024, it's sort of about $18 billion, went up to $51 billion. The gaming business, which is a legacy business, moved from $2.8 billion to $4.5 or $4.2 billion thereabouts. The professional visualization business seems to be a smaller one. Auto seems to also have grown almost threefold from $281 million to $592 million, and then there's some other revenue. So long story short, the total revenue has increased in under 2 years from $22 billion to $57 billion. I don't know of any company, maybe Apple is a good comparison in the 2007 range, if the acceleration in revenue was comparable to where it is today. Now let's look at some of the results and some of the data that that NVIDIA has showcased in the earnings call yesterday. It's seen significant growth in revenue, as you can see, from Q3 2025 of $35 billion to about $57 billion in the most recent quarter. The compute business has moved from $27 billion to $43 billion, and that's the bulk of the revenue for the entire business. They also have a networking business which is growing at a rapid clip. In fact, it's grown almost 3x in a 1 year time period, from $3 billion to about $8 billion. They're now claiming that NVIDIA is the largest networking business in the world. And if you were to look at it, the biggest competitors are the Ciscos of the world and Huawei. We don't know how the Huawei breakdown is, but Cisco's revenue is under $60 billion annually. So if you were to look, just cookie cutter, spread the $8 billion across the entire year, assuming a growth rate, I think they might be accurate that they have the largest networking business. And I think here lies a moat, right? They've built the best GPUs that's available in the market. They've spurred the AI revolution, but they also are kind of like going into components that is not as high value add. There are other competitors and other equipment providers providing networking equipment, but they're building the entire suite of offerings so that it's a turnkey service for their customers. So in a sense, it's a moat because they're backward integrating, and they're going into the networking business, which also has been paying them rich dividends. Moving on, the margins for the business have been solid. Gross margins of 73.4. Yeah, the fact that it moved from 74.6 to 73.4 is hardly a concern for me. They're transitioning from the Hopper systems to the Blackwell systems, and that's a transition that's ongoing now, where most of the customers have now either migrated fully or on the path to migrating fully to Blackwell systems, which is the GPU generation that they and the nomenclature that they follow. Operating income and operating expenses. So the operating expenses, despite the growth of 65% year over year, they have seen operating expenses grow up measly by about 25% year over year. And therein lies the strength of the business, right? Because all of the savings is going into margins. And the earnings per share has risen sharply from 0.78 to 1.3. And this is the biggest piece, right? The free cash flow. The free cash flow of the company has moved from $16 billion to $22 billion. So unlike an Amazon, unlike a Google or a Meta that is spending 80, 90, 100, sometimes $120 billion a year in capital expenditures, NVIDIA doesn't spend anything on capital expenditures. They have a research budget, I believe, of about $3 to $5 billion in capex on an annual basis, and that's remained steady, and that's what is going to continue going forward. So all of the value that they gain is from selling this IP. TSMC manufactures these chips. They just have the most sophisticated design and the most efficient design for AI chips. which is generating hordes of cash day in and day out. So to bring it all together, revenues increased by 62%, operating expenses have increased only by 36% year over year given the larger base. The net income for the company is 65% year over year. So all of the numbers seem to be pointing a very, very strong business and are going up to the right from a performance standpoint. Now, the outlook that they have projected going forward is that they expect the revenue to be in the $65 billion range, which is higher than the revenue for Q3. The gross margins they expect to be 75%, and the operating expenses to be in the $5 billion range. So I think there's nothing that's going to change quarter on quarter. It's going to remain a very, very strong business, and the growth rates are here to remain for the next couple of years, at least till the infrastructure build out continues. Now, the growth is great, but Wall Street seems to always be concerned about whether the growth rate is 60% or 62%. But rest assured, for one, that the 60% growth rate is going to come down significantly. It's going to drop like a rock over the next decade. And if you're an investor for the long term, I don't think it should matter to you whether the growth rate is 60% or 50% or 40%. As long as the company is delivering for its customers, it's having a brand and a customer, it's meeting a customer requirement that is consistent, and they're able to generate constant cash flows or increasing cash flows year over year. Margins are going to drop. There's going to be more competition coming in. Amazon's already got its Trainium chips. The GPUs from Google are Tensor, and they have also a chip called Ironwood that's in the wake. So everyone in this world today, given the fact that fabless design and design companies hold most of the margins, there's going to be a lot of entrants coming into this space, and almost all the large Magnificent Seven companies have some kind of chip development plans. Maybe they might be a few years behind NVIDIA, but rest assured that margins are going to dip. So how do we value this business? And let me tell you one thing at the onset, that none of this is financial advice. So do your own research. I use a platform called Ticker, which is an excellent platform for valuing businesses and for understanding the fundamentals of the company. So let's understand if all of this concern for Wall Street is justified. Let's sandbag and really project the worst case scenario and see where the company lands. Now, we know for 2026 has already played out. The company is expecting about 65% revenue growth. Let's assume conservatively that for whatever reason, for the end of the year, we have 60% revenue growth. But just to make sure that we establish a margin of safety, let's assume that the growth rates for the company are going to reduce significantly going forward. Let's assume that the infrastructure build out is an overbuild by all the Magnificent Seven companies. And let's assume that the growth rates go down from 60% to 35% to 30%. Either the growth rate comes down because of slower build out, or that there is more competition at the lower end where customers are willing to get, may not be as much dollar per compute, a much lower dollar per compute, but lower performance. And that takes away market share from NVIDIA to other companies. So we are assuming the doomsday scenario here, going up to like 20% growth rate annually. Let's also assume that the impact of that of intensified competition is going to be margin compression. The margins going down from 66% today to 46% in the next 5 years. We don't have much to say in terms of what is going to be they are aggressively buying back their shares. They're also like paying a lot of dividend, but there's no reason why we would want to change it dramatically today. So the way it works in Ticker is that I key in these factors, and eventually I come to what I think is what's going to be the forward-looking growth rates, the annualized returns, or the internal rate of return, as it's called, IRR, on an annualized cadence. Now, based on these numbers, which are extremely sandbagged, I have come to a midpoint of annualized growth rate of 16%. Will I be happy with a 16% growth rate over the next 10 years? Absolutely. You give that to me any day of the year, I will take it. So my point is that, again, I've done my research. I feel that there's a competitive moat from a business standpoint for NVIDIA, but there's going to be competition zeroing in. But even despite that, and taking in very, very low assumptions, I'm expecting the business to be growing at least at 16% growth rate over the next couple of years. But it's going to be very choppy because Wall Street is monitoring the stock feverishly. every movement from this company or everything that the company does, or even if there's going to be margin compression, it's going to impact all other companies in the ecosystem. So I feel that if you're in for volatility and if you're in for the long haul, which in the case of Wall Street, the long haul means 2 quarters, but if you're in for it for the next 5 to 7 years or 10 years, I think NVIDIA is a great company to buy and a great company to put your investments even at the current price, assuming some headwinds that are going to be hitting them in the next couple of years. So that's it for today. I hope this was helpful, and if you liked it, share and subscribe, and see you in the next one. Cheers. Bye.